Financial structures, what I'm telling you here is really small, medium-sized companies, all from Europe, private equity-owned, family-owned. What they're doing, financing plays part of it, but it's about financial performance. I hope that meets your expectations. Let's talk about the current economic context. When I was talking to some of you, I realized many of you have a lot of China experience already. And I think we all experienced the bull run in 2000, 2010, when economy was booming. I mean, GDP was growing. Almost every company was a winner. Some were only a winner on paper, but everybody was reporting sales, profit margins was up, and everybody invested in new factories and plants like Continental in your place. So in 2007, I saw that working capital went up, obviously, and headcount went up because there was just the growth. And then was the time, I think many of you remember, 2011, 2015, things got a little bit still good, but you could see China was maturing. With more competition, China still had growth rates that were better than many Western countries. Sales were still okay, profit margins still good. This is interesting, CapEx was still going through the roof. Working capital, this is a very important figure, and headcount also. So you could see it's very hard to gauge as a company executive, when is the time to adjust? It wasn't in this time. And then was the time what I call the cooling down. The cooling down when things became more competition, growth rates became a little bit more similar to what people knew from the West. But the economy was still, again, compared with, let's say, Europe or Japan, even compared to the US, was still comparatively positive, reasonable rates. Sales, many of you must have experienced that. Suddenly you had a Chinese competitor and there were more capacities than before. So prices already came under pressure. Sales didn't grow that much anymore. It's true for the profit margins. And again, I'm speaking from 20 years of experience on the ground. But the company still kept investing, right? I don't know whether you have the same experience. So still, not as much as before, but still big factories, still M&A. I did around 500 transactions I was involved in China. And I was sometimes wondering, okay, this big chemical factory, okay. And you could see that the signs on the wall already. Headcount still was going up. And since 2020, I think this is, particularly after the COVID measures, this is a new reality. So we have the economy, China is growing 4-5%, but this is pretty much investments also of the government, exports. But we have huge overcapacities in many manufacturing sectors. So sales are sometimes not going up anymore for many companies. They're even declining. Profit margins are under huge pressure. All of my clients and companies where they look into to do joint ventures or cooperation, the profit margins are still, they're still profits, but they're much, much thinner than they were before. CapEx, I think people are staying away from major, bigger investments at the moment. But working capital is going up because customers don't pay. That is a big problem. And headcount, companies are now a little bit more cautious. Golden days over. Many small, medium-sized enterprises have reacted too late to the realities of the maturing economy. The cash flow suffered a lot. I'm literally in the cash flow business now. And client companies just call me and say, okay, we need a dividend, we need cash. Also, because they don't want to send money from Europe anymore. That's a big point. They want that China is self-sufficient. Some SMEs, what some of my customers are doing, and there are some pretty smart people I see sometimes, many of them have a lot of experience, also because of, like people like you who are on the ground for many years, know their way around. Also because of initiatives like yours. This is a much better understanding of China now. And smaller companies, I'm talking about companies that have maybe 200 people worldwide, maybe in Germany and China only, up to maybe 2,000-3,000. That's the size I'm talking about. Financing. Does anybody of you know about this BSF financing? That there is a corporate bond you can buy in Chinese banks? This is a BSF corporate bond. Does anybody know about that? That's quite interesting. I think this was a pretty smart thing. You know, they have a huge plant now in Zhangjiang in south of China. Total investment is 10 billion euros. I think it's either the largest investment in BSF's history or at least the largest overseas investment. I think was quite smart. It's different ways of financing, but they issued a corporate bond. So in renminbi to finance that construction. Now you'd say, what does it have to do with a small, medium-sized enterprise? I show you a little bit how companies finance themselves. This is People's Bank of China, Central Bank of China. It's a bit, this is the latest figures I could get. But from my experience, it hasn't changed much. So most companies get a bank loan, okay, for the working capital for a new factory or whatever. And as a matter of fact, particularly small, medium enterprise very often depend on the mother company, the mothership in Europe, to issue a guarantee. And then they work with international banks and then they get the loan paid locally. But it has two issues. First, the parent company has to issue the warranty. So it does have an impact on their, let's say, credibility when they want something for themselves. So it's not a great solution. Then there is even, it's funny, the shadow banking. So even the People's Bank of China knows about the shadow banking, has even figures for that, you know. So that's usually a way that's not a form of financing that's available. This one is interesting, bond market. There are foreign companies that obtain local bonds and that can lower the financing for CapEx or working capital substantially. And I do recommend to my customers, if you have healthy business, don't have everything financed. My clients are usually private equity or family owned. And they're feeling the squeeze now. Try to leverage your assets. If you have a land use right, leverage that. If you have something to get a bank loan, don't always use the parent's guarantee. So I have now a company, they have, I wouldn't call it a bond, but they have a special, it's called an investment product with a Chinese bank. So Chinese customers can buy this product. They get a higher percentage, higher rent, higher yield, but it's cheaper than a working capital facility that you would normally get on the commercial terms. The growing corporate bond market offers large SMEs a chance to localize their financing. I think this is very important. I showed you this table. In the golden days, Europe or headquarters sent money. And I think these days, I wouldn't say they're over, but most, when you hear about foreign direct investments like German car companies, is profits they make from the joint ventures, they reinvest. It's not fresh money that comes from Europe. And I can, from my own experience, really recommend to look into this sector, into this form of alternative financing with banks. It's cheaper. The banks like to do this because it's also good business for them. And more small and medium-sized enterprises are doing that. Capital expenditures. This is a very, very important topic. Fixed assets investment falling 6.2% year over year in the third quarter. The sharpest drop since 2020. This is from the Bank of America, their chief economist. So it's actually also important for you to understand that, you know, the overall economic climate does have an impact. And you saw in the table before that particularly the foreign companies have, from my perspective, overinvested, particularly since 2015. So they're sitting on a lot of production, let's say, capacity. I see companies being very, very creative to say, wait a moment, do we need to buy land? Do we need to build a new factory? Do we need to do this? Actually, what you spoke about the renting is quite interesting. So what do particularly family-owned businesses do now? And that is a completely different thinking. I remember I travel a lot through Europe to meet my customers. And they always say, yeah, we have a new land use right. We met the mayor, you know, the red ribbon cutting and everything. That mindset has changed. They're thinking far more in terms of capital efficiency. And very often they're even selling land and they're selling plants. I help them, and usually this is in a form of M&A because they have a joint venture part, or they sell the whole thing en bloc to another company that wants whatever, a real estate developer or something. And what they do instead, they very often rent production equipment, they rent buildings rather than constructing a plant themselves. And I can only echo what you just said, and also you said, help is very important. A small, medium-sized company, I told you, they have sometimes only a few hundred people worldwide. if there's a problem with the construction or suddenly the budget, what a surprise, gets out of control, you have no resources. It's very difficult to manage. So sometimes you need a strong friend who can maybe help you, and that renting is a big topic. I recently gave a short lecturing in Hong Kong at the City University, and one of the participants was an executive MBA program. What he does, he has automated logistics machinery, and he says many companies don't have the cash to pay. So they offer me, oh, I pay you in 6 months, 12 months. And he says, I don't want to do that. So he leases that. So leasing is a big thing. And in the Chinese mindset, also in the foreign investors mindset, this was, in Europe, it's totally common. But in China, this was always, I need to own everything. And that is changing. So renting and leasing is becoming a big thing. Leasing non-core machinery is a big thing. Many machines in a factory are non-core. Of course, there's something very, very specific about the product. Then you need tailor-made machinery where this is not possible. And increasingly choosing locally manufactured equipment. This is a big thing. And locally manufactured equipment includes foreign brands, but they produce it here. And the price difference is sometimes it's mind-blowing. So I had one of my customers said, I now get such a good price from the same supplier I buy from in Germany, and now but they didn't tell them. And the only reason how they found out is whatever, I think was even a competitor he met over a drink and said, oh, you're still buying that from them? No, buy it from them here. So that is that helps a lot to get some relief on the capital expenditures. I think you must know this kickback. I went recently through a project where someone said, I have so much equipment and I don't know what's going on. They bought a new machinery, and headquarters was always approving everything, relying too much on the local general manager who had his own agenda with the supplier of this machinery. So they bought all kinds of expensive machinery and totally unused. As a former auditor, I said, why? There's no lamps on. I'm not an engineer, so the only thing, but I remember when I did audits and there was an assistant, the audit partner would say, Mike, when you see a machine, there's no light on, there's dust on, it's because they don't use it. And in accounting, if you don't use something, there's a risk, it doesn't produce any money, and then you have to write it off. So I went to, in my old assistant mindset, hey, what's going on here? And then he said, yeah. And then we investigated, and there was a kickback scheme behind it. So the general manager is gone now, but the damage has been done. Right? So these family-owned businesses are now far more familiar with these practices. What they often need is someone who has been on the ground for a long time. And now the gray hair or no hair executives are coming back. They are appreciated again. Outsourcing non-critical production of components. For many of you, that might sound totally normal. To say that is something, a case, a metal case, or a certain simple product, we produce it in-house, was totally normal, vertically integrated. As they were familiar with that in Europe or in the United States, now they are far more often let really complex things be manufactured by a local producer who offers totally different pricing. And that also helps them, of course, to lower the capital expenditures. And very successful. Of course, you need to manage your IP, you need to manage your branding, but this is not a big issue if it is a non-core component. Very important is return on capital employed can be a little bit, you couldn't do too much about it. But in the GM contracts I've seen, again, 20 years on the ground, I've seen contracts that were 2 pages and enormous compensation. It said, and how about the bonus? Yeah, this is discretionary. And the problem is, if you want to get rid of such a GM, they go to court. The judges, this is the practice I see, I work with a law firm for this, and they say, the judge goes into this, said, look, you paid them so and so much, and you have to do that when you separate. Now, when new GMs come in, they understand very much what is the capital implication of compensating this or that way. So return on capital employed becomes much, much more important than it was 10 years ago. Yeah, human resources is a little bit a sweet, sour topic, but I need to talk about it because this is a huge change. I think many companies thought that China will grow 10% a year for the next 200 years. No country has ever done that. Staff, headcount, and compensation do not reflect business realities. And this is what small and medium enterprises are doing about this. And I say that some people will say, what does it have to do with financial structures? At the moment you have an employment contract, particularly for your executives, I can see that maybe it was, I don't know, good faith in 2015 when this was done. They didn't think about what happens if I need to fire someone? What happens if I need to adjust because my customers chase me on the price and the prices are going down and the incentives were maybe sales figures, but now the sales figures are at a lower profitability. So HR is besides raw materials, this is becoming now, like Europe, a very, very expensive part. In many ways, China has Europeanized with regards to employment contract law. It's very similar sometimes, you know. So this is something I can only really recommend. They increase now the variable portion of executives' remuneration, and it's not only sales, and it's not only the net income in the audit report, because very often there are situations, there's a net income, but there's no cash in the company. And why does it happen? They accept all kinds of orders, all kinds of sales, even though they get paid later and later. There are all kinds of tricks to or change depreciation figures to show profits, although the cash is not there. So companies, I like working with family-owned businesses. I like working with private equity-owned because they're very sensitive, because it's their money. And they say, look, we need a real result, and a real result needs to be based on the liquidity we are earning and not just on some book figures. Make use of normal staff fluctuation to lower your headcount figures. It's not a nice topic, I know that, but in Western countries, if you try in Germany, Spain, Italy, France, if you try to make people redundant, it's a very painful process. And China seems to go the same way. Yeah, maybe you're becoming more French. And so you have, if someone now goes into retirement, there needs to be a restructuring. And that is what many companies are doing now to avoid, let's say, hard cases or certain hardship when it comes to redundancy. And this is the third point, is something family-owned businesses have learned: limit the term of your general manager. There are more details about this, but I think today we're just having a little bit, we're scratching the surface of that matter. No open end. There are certain limitations that what can be done, but you can do much more than what most companies do. My experience is now, and maybe later we can have over a beer or two talk about this. I see a trend like from 2015, many Western general managers were replaced for many reasons. I don't want to go into this. And like in good faith or whatever, they just put in someone they found through a headhunter, and the performance is not stellar, absolutely not. But when they now try to change something, contracts, compensation, or get rid of the person, they go through hell. And I sometimes go with my clients to these arbitration meetings. Oh my, it's really a Waterloo for many companies. So sometimes there are many other things that need to be considered in a GM agreement, but limiting the term can really help at least to stop the bleeding. Performance improvement plans, as a lawyer told me, this seems to be the term. Companies are making much more efforts to say, this is what I expect from you, and I measure your performance, because this is relevant if they really need to reduce the headcount through redundancy. And the small companies and medium-sized companies are far more aware, they have far more knowledge about the Chinese employment contract law and the real practice in the arbitration courts. Outsourcing, this is a little bit like the machinery. And I remember I also have now a client building up, they sold their joint venture part very successfully. They like China, they have an OEM manufacturer, and they want to do more in China. and they have someone in charge. And what does the person do? Oh, we need an HR department, we need a finance department, we need someone who looks after this. They say, hey, wait a moment. You have worldwide a few hundred employees. Why do you want to do this? You know, and there is this. Maybe some of you know Parkinson's law. This was a British bureaucracy researcher in the 70s. He was looking at the public sector, but this Parkinson law is now pretty much known for corporate developments. You have a head of HR, it takes 2 years. Head of HR says, I'm overwhelmed, I need an assistant. And she says, hey, now so much work, I need an under assistant. And you have a mushrooming organization. And this was also done by medium-sized, I see someone laughing, that's exactly what I see that when I say my client, well, why would you do this? Your profits are gone. Yeah, this is only in the first 2-3 years, but then we will outgrow this. I say, no, you will not. So now there's a different mindset. So there's far more thinking in it. I outsource my HR department. I outsource my finance department. If you have a team of 20 people in China and you focus on maybe selling, maybe you have an OEM manufacturer, you don't need a finance department because the complexity is not yet there. So outsourcing is a big topic now to get the costs down and increase the financial performance. This point, number 6, seems to be trivial. Most companies don't do that. I have every week when I go talk to companies, I say, so when was the contract last time updated? In many cases, since that person is on board, it's the same contract. You know, and there are many ridiculous things. It's not only the payment, it's also what if there's a compliance case? What are you allowed to do? What you're not allowed to do? And if you don't do that, you lose a very important tool to manage your headcount. And I see some of my clients now really being aware, going to such events like this, going to whatever, the AHK or whatever, meet their lawyers, talk to people who were maybe general managers in China for 10 years, and they tell them how they do things. And this is how knowledge gets proliferated and how they improve the situation. The key conclusion, believe it or not, what's changing now is SMEs have increasingly realized this. Revenues are vanity. They're not in this, oh, we need to grow 10%, 10%. This is some of the good ones understand revenues need to be profitable. And even if there are profits, and this is a tough time at the moment in China, and not only in China, worldwide, you need to do something that increases your cash flows. I spoke with some of you. My clients want a dividend. They say, hey, I'm 20 years in China, 10, 15 years in China. It's all fine. Those of you who come from business valuation know the value of a company only comes from one thing, is cash flows. And they get discounted, and if there are none, you can have as many profits as you want. The value is zero. And that is changing. So what's happening, they're going through each and every line of their financial statement and say, what can I do differently to get more cash? Can I say no to a customer? And sometimes they say no to a customer. They don't want these papers, these commercial receipts, instead of a payment, which it's called the IOU now, is a nickname in China. They don't want this. And they don't want to do business with whatever BYD and get paid in, I don't know, 50 years. Yeah? So, yeah, that's pretty much it. I hope it was not too trivial, but you know, sometimes the basics are not done in real life, and they're not done in businesses. And I see smaller, medium-sized companies still interested in China, but they have learned the lessons and they're changing their thinking. So they are thinking far more in terms of, hey, okay, China is a mature market and there's a rough competition with very competent competitors. What do I have to do differently? And this is, what they're doing. If you want to stay in touch with me, I think you can share this with whoever wants that. Yeah. And I can tell you more war stories later, maybe over a drink or so. Yeah. Okay.